Hello, everyone. First of all, good day to you all. And to start with, I just wanted to share an important event from India perspective. We had our 75th Republic Day today. It is related to the constitution which we had in the year 1950. So 75 years from that day have passed. So it was an event full with celebrations and the President of India and French President also participating. So a great and a memorable day for all of us and wanted to share with you all. Secondly, it's a pleasure to have Mr. Atul Gupta for our webinar today on the cross-border transactions and the applicability of GST on that. Needless to say, people who would know Indian chartered accountancy profession and the professional body which is Institute of Chartered Accountants of India would know Sri Atul Gupta ji as well. To start from his profile perspective, I must share that over the period he has been able to rise to the highest position from an accounting profession perspective to acquire the position of the president of the Institute of Chartered Accountants of India for the year 2021. ICAI or Institute of Chartered Accountants of India is the second largest accounting body in the world. And his selected career credentials, he has been a chairman of Digital Accounting and Assurance Board of Studies, IT Committee, and Indirect Tax Committee of the Institute of Chartered Accountants of India. Under his stewardship at Board of Studies, the new scheme of education and training was benchmarked with the revised international education standards and was launched in 2017. He has been a chairman of ICAI, Accounting Research Foundation, and Extensible Business Reporting Language, which is XBRL, India. He has been the director of the governing body of the Indian Institute of Insolvency Professionals and Registered Valuers Organization. First chairman of the Accounting and Finance Services Selection Committee, constituted by the Bureau of India Standards. Member of various accounting, insurance, and capital markets committee. With his deep interest in research, he is credited for the project of preparation of accrual-based financial statements of the Indian Railways, which is the third largest railway of the world, under the ambit of Accounting Research Foundation. He has authored various books, published articles in leading newspapers, and delivered as many as 1,600 lectures. He has served the accountancy profession for more than 2 decades and is widely respected for his strong organizational skills and deep insights in the affairs of profession. In terms of education, last but not the least, Sri Atul Gupta ji is a PhD, an MBA, a chartered accountant, cost accountant, a commerce and a law graduate. So Sri Atul Gupta ji, welcome aboard to our organization FENG and to our webinar today. We are really looking forward to share your insights on the cross-border transactions and applicability of GST. Sri Atul Gupta ji, sir, please.
Yeah. Thank you, Vinit ji. And thank you, Charlotte, and all my colleagues who has given me this opportunity to participate in this international program being organized by the FNG. And congratulations to all our participants for the 75th Republic Day of our country, India, wherein in the morning there was a lot of celebrations around that. As rightly mentioned by Vinitji, that today we witnessed the guest of honor for the program as the president of the French France. Now, my dear friends, the topic today is as being assigned to me is the cross-border transactions and the applicability of the GST around that. Now, my dear friend, when we talk about the cross-border transactions, there will be the two type of transactions. One is that when you are importing into India, or like there are the goods and services. Now, you may be importing goods into India, or you are taking the services from outside India. So this is the one limb of our discussion. And the another limb is that we are exporting. So we are exporting goods, we are providing the services overseas. So I am located in India, I am providing the services overseas. Then what will be the applicability? So it's both the import and export that we are going to discuss, that what is the applicability of the law and how like the various compliances are there around that. So as I mentioned you in the entire presentation for the next 40-45 minutes will be divided into the 5 parts. Number 1, that the which transaction attract the GST or classified as exports. So for example, you are rendering certain advisory services from India. So whether that will be treated as export or not. So for example, you are based in US. Now you are taking the services from India. Now whether that service will be treated as export, or the guy who is providing the service from India has to charge the GST on that, is something that we are going to discuss. Similarly, if you are providing these services from USA to India, in that case, what will be the tax implication? That also we will deal in this duration. Now, my dear friend, in case my services are treated as export, meaning thereby my activity will be qualify for certain benefits. So what all benefits will be there in case my services are being treated as export, or my goods, whatever goods I am sending outside India will be treated as export. So what are the incentives which are available in the GST regime? Then in case I took the benefits, I took the incentive, but that later on the government of India, or I will say the Department of GST, feels that this is an erroneous refund. So meaning thereby they feel that, okay, the refund you have taken or the incentive you have taken is actually not legitimate. Then what will be the procedure to recover that amount from the person is something that we should also discuss. Then, my dear friend, in case the activity is not treated as export, then what procedure we have to follow? What is the guidelines around that? And last but not the least, that in case you are dealing with a related party. So as you are aware that there are the OECD guidelines as far as the transfer pricings are concerned for the income tax or the poem purpose. But now in the GST also, there are the provisions which talks about the arm length price. So if you are dealing with a related party, say, for example, you are a holding company and a subsidiary company. So holding company is located in India, subsidiary is located in USA and vice versa. And there are the transaction between them. Then how the arm length price will be calculated is something that we need to deliberate upon. Now, my dear friend, let us start with the first point. That is the in case I am supplying the goods from India to a foreign territory, or I am importing the goods from a foreign territory in India. In that case, we have a very specific provision and which deals with this kind of a situation, and that is there in the IGST Act. I just wish to share my colleagues who are viewing this program. In India, there are the 3 different acts which are governing the entire GST law. One is a Central GST Act, that is called CGST. The another is a State GST Act, because the India is having more than 29 states and then union territories are there. So there is a state law, though they are all coordinated. So it's not a case that the state law will have a different definition or the different provision. The entire law of a central government is a replica at the level of a state government as well. But there is a provision called State GST. And when there is a cross-border transactions are there, or the transactions are from one state to another state, then the provision of IGST, that is the interstate GST or integrated GST provisions are there, which are applicable. Now, my dear friend, when we are talking about the cross-border transaction, the provision which are there in the law are governed by the IGST, that is the integrated GST law, which I am showing on your presentation, on your deck. Now, my dear friend, as I mentioned you that in case somebody is importing from outside India, from a foreign territory to India, so what will happen? So just to share with you, it's a very simple question and a very simple straight answer, that when you are importing into India, then you have to pay the custom duty, the basic custom duty, which is not subsumed into the GST law. In the GST law, when it was introduced in 2017, all the indirect taxes, whether it is a central government or a state government, got subsumed into the GST law except the basic custom duty. So meaning thereby, when you will import, so say for example, you are importing a laptop from outside India, then you have to pay the basic custom duty at the level of when the bill of entry will be submitted to the custom authorities. Now, apart from the basic custom duty, there is a provision in every jurisdiction that is to safeguard their local industry, that is called the CVD, that is countervailing duty, or in certain countries there is a special additional duty which was earlier applicable. In a short form, they are being called as CVD plus SAD. Now, when the GST was introduced, this CVD and SAD was subsumed into the GST in such a way that now, after the introduction of the GST, apart from the custom duty, you have to pay the GST as well on the import of goods vis-a-vis services. Now, for example, I am purchasing a laptop for $1,000. And if the basic custom duty is 10%, then I will pay the $100 as a custom duty. And if the rate of the GST on this laptop is 18%, then I have to pay the 18% as a IGST on the import of this laptop to the custom authorities itself. But the benefit which is available now, which was not earlier available, that this GST I paid, that is $180, will be available as a credit to set off against my output liability when I will be selling this laptop in the local market. So say, for example, I imported 100 laptops and I paid the 18,000 as a GST, and then I'm selling that laptop in the open market, in the domestic market, then whatever the GST I paid on the import of goods, that will be available as a set off, as a credit, which I can set off against my output liability. So when I will sell in the domestic market, I will collect from the customer, and rather than paying the 100% amount to the government exchequer, say for example, I collected 20,000 as a GST. 18,000 I paid earlier at the level of a custom. So what I will do, I will pay 20,000 minus 18,000, that is $2,000 to the Indian government, to the GST Department of India as my final liability. So my dear friend, in a very simple language, I try to clarify you that in case you are importing from outside India, if the goods are there, you have to pay the custom duty plus IGST. But in case it is services only, then you have to pay only the IGST, not the custom duty, because there will not be any custom barrier you have to cross. You may be importing the services on a mobile, on a laptop, on an internet basis. So there will not be any custom barrier. So that's why there will not be any custom duty. It will be the IGST you have to pay, and the normal rate of tax which is there in the country is 18% flat. Now, my dear friend, if I go with the export of services, because that will be also an important point which we need to discuss, that say, for example, Vineet ji is located in India. Now, he is providing these services overseas. Now, whether the Vineet ji will get the benefit of treating the activity as export. Now, first of all, I wish to clarify you that if Vineet ji service will be classified as an export of service, the other name of an export of service is a zero rated service in India. Meaning thereby, when I'm saying your activity is a zero rated, meaning thereby they are being treated as exports. But in case the activity is called as nil rated, that doesn't mean it is an export. Then that means that activity is taxable at the rate of 0%. Now, my dear friends, so that's why there is a difference between a nil rated and zero rated. I just clarified you. Now, in case my activity, the Vineet ji activity is classified as a zero rated, meaning thereby exports, what will be the benefit available to Vineet ji? Now, the Vineet, what will happen that if Vineet will qualify, fulfill all the condition of export, and his activity is services he is providing to a foreign territory, will be treated as export. So what will be the benefit? That the Vineet need not to charge any GST from the recipient, number one. Number two, that the whatever the input tax is available. So say, for example, the Vineet is rendering a service of a $100,000. Now, he is not required to charge any GST on that. But at the same time, he may have taken the $70,000 services from the various vendors to provide these $100,000 services at the overseas level. Now, on that $70,000, whatever he paid to the various vendor in India, he must have paid the GST as well along with that. So meaning thereby, that is called the purchase tax. That is called the input tax. That is called the ITC, input tax credit. Now, my dear friend, the benefit which is available to Vineet, that not only he doesn't require to charge from his overseas buyer, but also he is eligible to claim the refund from the department of the entire purchase tax or the input tax he paid to the various vendor in India on that $70,000. So say for example, on $70,000 at the rate of 18%, he paid $12,600 as a purchase tax, as a GST. Now that $12,600 will be available to Vineet to claim the refund from the department as an incentive, so that his export can be boosted. The government of India is looking to motivate Vineet that okay, do more and more exports. So to motivate Vineet to do a more and more export, they are giving the refund of the purchase tax, whatever the taxes he paid on the acquiring the various input services to provide that output service. Now, my dear friend, coming out from that incentive business, let us understand when Vineet activity will be treated as export and when it will not. Now, my dear friend, as I mentioned you in the place of supply provisions. So in India, when we are discussing that whether the activity will be treated as export or not, it will be decided by the place of provision. So it will be decided as a place of provision. Now, my dear friend, just to share with you, for example, that the Vineet is here in India and he is rendering the services in, say, for example, in USA. Now the recipient is in USA and the supplier is there in India. Now what will happen, that in the normal principle, the place of provision of this service will be called the location of the recipient. So in case the person who is receiving the service is in USA, then the place of provision will be in the USA, and as per the provision, this service will classify as export. So this will be treated as export. This is a general provision. Now, in case the place of provision of any activity will not be in the USA, will be the, for example, I will be sharing you certain services where the place of provision will be treated as the location of the supplier only. So the place of provision will be in India only. In that case, the services are providing from India. The place of provision is also in India. In that case, this service will not be treated as export, as I just shared with you. So I am trying to convey you, I am trying to clarify you that how I will be able to determine whether this service will be treated as export or not. It will depend that where the place of provision of my supply is there. So if my place of provision, the place of supply of my activities in a foreign territory, I am very happy. It will be treated as export and I will get a lot of incentive. But in case the place of provision, the place of supply of my activity will be in India only, in that case, the benefit will not be available, even if the payment are being received in the foreign convertible exchange. So even if I am getting the money in the foreign exchange, hardly matters to me. I have to check where the place of provision is there. Now, my dear friend, just to share with you that when we are discussing about this, the general principle in the GST law is that for every service, the place of supply, the place of supply or the place of provision will be the location of the service recipient. So say, for example, Vineet ji is rendering a consultancy services. He is located in India. He is providing the service in USA. The place of provision will be the location of the recipient. And in case the location is located the recipient is located in USA, his service will be treated as export. So no problem. There is no need to charge the tax and he will get the refund of the whatever the input tax credit is there. But my dear friend, they have given the exceptions that from a subsection 3 to 13, I am giving you Vinitji 10 services, the 10 type of classification wherein the place of supply will be the location of the service provider. Meaning thereby, the following 10 activities will never be treated as exports. So the general principle is that everything is export. So if you are located in India, the recipient is located in the foreign territory, your activity will be treated as export, but except the following 10 activities. Now, in the 10 activity, the first activity will be that when you are doing certain repairs. So say for example, you have to do certain repair of the machines, and the machines are coming to India to get them repaired. So what will happen? It is a performance based service. And in that case, when the performance are there in India itself, the machines came to India. It is not that remotely you are, say for example, there is a problem in the laptop, in the software. Now you are repairing the software in a remote way through the internet. Then there is no problem. But if the machines are coming physically in India to get the repaired, and even if you are getting the money in the foreign exchange for that repair services, still that activity will be treated as not export, because the place of supply, the place of provision of that activity will be treated in India only. So I'm trying to make it a very layman language so that my friends from overseas and various other locations can understand in a layman language rather than speaking on a very technical, I will say the legal provisions. I'm just giving you the fundamentals. So what they say that when the the assets required physically available, in that case, the activity will be treated as a performance-based service, and in that case, the place of supply will be the place where this performance happened. So if the performance happened in India, the activity will be treated as not export, will be treated as a taxable supply, and it will attract the GST. As I mentioned you that in case it is a remote location, say for example, electronic mean you are doing, in that case, the place of supply will be the USA only, and your activity will be treated as export, as I mentioned you. Then, my dear friend, coming to the next one, that if you are rendering the service related to the immovable property. So say for example, you are a real estate agent located in USA, and the owner of the property is located in Mumbai, and you are providing a real estate agent services from USA. Okay, rather than vice versa. Let me take another example. That Charlotte has a property in Mumbai, and Vinitji, you are providing a real estate agent service to Charlotte. That okay, I will get this property on a let out. Okay, for a say for example a $50,000 per month. Now you will be charging 10% as a real estate agent services for this entire services you have provided, because you arrange a tenant for her. Now the $5,000 you are claiming as a real estate agent services, and you will be getting a money in the foreign exchange as well. But since the activity relates to a immovable property, so in that case, the place of provision says that wherever the property is located, the place of supply will be that location rather than the location of the recipient. So what will happen? You are located in Mumbai, the property is located in India, and Charlotte is located in USA. But the place of supply will not be the location of the service recipient. It will be the location of the property. And since the property is located in India, you are also in India, the place of supply will be in India, and its activity will not be classified as export, as I clarified you, and it will be a local service, it will be a domestic service, and will attract the GST. Now, rather than discussing each and every point, because we have a very limited time available, I am just touching upon a very, very important point, Vinitji, which is the intermediary services, because the entire litigations, when there are the cross-border transactions, 99% litigations are there on this particular clause only. Now, what is this intermediary services? Because when there are the, say for example, you are a buying agent here. There is a company in USA, and they are looking to purchase certain clothes, or maybe they want to have a regular supply of the clothes. Now they are telling you, or they are the supplier of the clothes as well. They appointed you to provide certain services in India. Say for example, you have to find out the buyers, or you have to do an inspection of the clothes, or you have to go to the buying house who will be buying your all these things are there. Now, whatever the services you are offering to the USA, and for that you are getting paid, whether that activity will be classified as export or not. Now, my dear friend, in the case of intermediary services, the law which was there even prior to the GST says that in case you are an agent, you are a person who is providing the service to your client on a principal to principal basis, meaning thereby there are only two parties involved. You are providing the service and he is the recipient. In that case, that will not be an intermediary services. But in case the person is located in USA has to provide a service in Gurgaon, in Mumbai or in any other place, and you are providing on behalf of that USA person, meaning thereby you are an agent of a USA person. In that case, your activity will fall under the intermediary services. And in that case, the place of supply will be in India rather than in USA. So what I'm trying to convey you, that in case the person, the Vinitji, when you are rendering certain services to your USA client and you are working as a principal to principal basis, you are not acting as an agent to the foreign buyer, okay, the recipient of your service. You are not acting as an agent, but you are acting as a principal to principal. Say, for example, you are running a BPO. Now, the company is sending you the certain information or certain data, and you are getting processed them like a legal LPO, KPOs, BPOs, all these things are there. You are processing their data and then sending back the reports, meaning thereby you are working as a principal to principal. You are doing certain research on behalf of this X and Y company in USA, that what is the market size, what is the market potential in India. In that case, you are doing a research, you are giving the report. Now the company want to invest or not, it is a company call. Okay, so the USA company may invest in India on behalf of your, based on your reports, but that is that you are not acting as an agent for them. You provided your report as an independent person, and there are the various jurisprudence, various judgment on the Honorable High Court and the Supreme Court, where it has been upheld that if you are working as a principal to principal, then there will not be any taxability and it will be treated as export and you will get all the benefits. But if the Mr. Vineet is acting as an agent of a foreign service recipient, he is doing certain activity on behalf of this foreign recipient to a third party. Say, for example, I'm giving you another example, that the foreign party, the foreign buyer has to do an inspection. Okay, has to do an inspection of the manufacturer when the clothes are getting dispatched. Now, Viniji, you are doing an inspection on behalf of the foreign company, and then you are reviewing that whether the clothes quality is good or not. In that case, you are acting as an agent of that company, and in that case, the activity will be classified as the intermediary services. You are arranging the orders. So you are doing a market promotion, and based on the market promotion, you are arranging the order and you are giving an order to the your principal located in USA. And based on the orders procured by you, the USA guy is sending the goods to India. In that case, whatever the commission you are earning will be classified as the intermediary services, and the benefit of the export will not be available. So what I'm going to discuss with you later on, that in case you have get the RNS refund. So at times what is happening, that it's very important when the agreements are getting drafted, it's very important that we understand whether my activity, whatever I'm writing in the agreements, will classify as me as intermediary services or not. If my activity will classified as intermediary services, the benefit of the export will not be available. You have to charge the 18% GST from your foreign counterpart and then pay to the government. But in case your activity classified as not a intermediary services, not only that you need not to charge, but also you will get a refund of the input tax, whatever you paid on your purchases. So that's a very, very important point, which I believe that we should discuss in detail. And that's why I'm giving a lot of time on this. Then, my dear friend, there are many services like this, which are there. I have given in my presentation but they are less of our interest. That's why I'm skipping all of them. Now, my dear friend, coming to the next one, that, okay, my activity is a export. So my activity is export. I clarified you that in case you are entering from India and the location of the recipient is outside India, your activity is classifying as export, you will get the benefit that there is no need to charge. You no need to charge on the export, and you will also get the refund of the input tax whatever you have paid on the import of on the purchase of the various activities or the procurement of the various input services. Now, my dear friend, coming to this. So what will happen? There will be a refund. So as I mentioned you, the IGST paid on the zero rated supply, meaning thereby that in case you are now, Vinitji, I just wish to clarify you that now one thing is clear to all of us that my activity is export. Let us assume my activity is export. Now, how to deal with this? So I understand that my activity is export. Now I have the two
Right.
way. I have the two way to take the incentive from the government. One is I will file a LUT, letter of undertaking, that okay, I will file a LUT to the department, and based on that, I will not charge. Please, say for example, $100,000 I am exporting. So I will not charge 18,000 rupees from my buyer. Okay. And whatever the input tax credit is there, I will claim the refund of the same. This is one methodology. So what I will do, I will file a LUT. I will not charge from my buyer, and whatever the input tax credit is there, I will claim the credit refund of the same. The another option which is available under the government law, that you charge from your buyer the 18,000 rupees, $18,000 on this $100,000 billing, and you claim the refund of both this 18,000 plus the input tax credit, whatever is available on the procurement. So there are the two methods. So as it is being given, the IGST paid on zero rated supply, meaning thereby in this slide, he is taking the second option, that he is paying the IGST on the export. He will claim the refund of the same as well, plus he will claim the refund of the input tax credit on the procurement, on the purchase tax, whatever the purchase tax is paid. So there are the two, one is one limb. So one, my right hand side is my export, my left hand side is my purchase, local purchase. Okay. So I have the two option. I repeat again and again that I have the two option. On a right hand side, when I'm exporting, I can charge IGST and claim the refund from the department, or I can file a LUT. On a left hand side, that is my purchases tax, I will be eligible to claim the refund in both these situations. Okay. Now, my dear friend, as I mentioned you this, that there are the refunds which are available. Now, how we have to claim these refunds is something that I'm going to discuss with you very briefly. So number one, that there should be export of goods or goods or services are there. And there is a system, the custom portal, that is called IceGate. So I will just request you that you please read this presentation later on, that there is a portal, the custom authority portal called IceGate, wherever all the shipping bill details, all the return details, whatever you are filing should match, then only the refund will be available. In case, Vinitji, there is any mismatch between the IceGate vis-a-vis your GST filings, if there is any difference between the shipping bill, IceGate and your GST filing, then your refund will be stuck and there will be another kind of a situation will be there. Now, I will discuss with you this reconciliation part, but just to share with you up to when you can file the refund. Okay. So you have to claim the refund from the department for whatever the purchases tax you have paid. So the section 54 of the GST deals with this particular provision and say that within 2 years from the relevant date. So meaning thereby, if I'm exporting in 2024, in January 2024, I can claim a refund from the department by 2026. So I have they have given me the 2 years time. So say for example, by air, I'm sending the goods by air. So when I will be, when the period will start of 2 years, the date on which the ship or aircraft in which the goods are loaded leaves India. So the moment, say for example, today is 26th of January, the goods are traveling, the exported goods are traveling from by air. So from this 26th of 2024, 2 years down the line, I can claim the refund from the department, whatever the purchase tax I paid to manufacture these goods. This is the period they have given, that after this, the no refund will be entertained. And even you can file tomorrow, but maximum period which is available is 2 years. Now, this is the reconciliation part, which I just share with you, that when the exporter will be generating a shipping bill and will be uploading on the custom portal and getting a bill of lading, they have to file all this detail into their returns. So these two are the GST returns. So they have to file, this is called sales return, and this is called the challans, the payment, when you are filing your tax details. So this sales return and the challan when you are submitting to the GSTN. Now what is this? The GSTN is a dedicated portal which receives all the return. So it's a government authority which is receiving all the returns. You will be submitting their return and they will be transmitting the data to this custom portal. And once the data match, if the data will match, you will be eligible for this refund. But if the mismatch will be there, then there will be a query which will be generated by the department, or there will be a inquiry letter which will be issued by the department that you please get this reconciled, otherwise I will not allow you to get the refund. Now, what kind of a things which are normally we have to take care? I have prepared this something as well, that what all we have to match. So invoice number, the date of invoice, invoice value, nature of exports, what we are doing, shipping bill number, IGST paid, all these things. And these are the custom mistakes which the normally guys are doing. So I have just jotted down what kind of a mistake Viniji everybody is doing when their refunds are getting stuck by one or the other reason. The another very, very important reason which is happening these days in India, that if your purchases are alleged to be a fake, okay, the vendors who supplied you, their registration got cancelled later on. So then also the department will stop your refund claim. Say, for example, you purchase a $10,000 item, something is there, and the supplier who supplied you this $10,000 photocopier, let us assume that you purchase a photocopier for $10,000, and later on the vendor who supplied you the photocopier vanished. His registration got cancelled by the department. In that case, your refund will be stuck because the department will say that you are a risky exporter. Then these are the advisories I wish just attached with this presentation. And these are more or less equivalent to what I discussed with you, that you should match the shipping bills, invoice, the shipping companies or the person in charge should file the EGM and the bill of lading carefully. While you are filing your returns, all the data should be matched. No invoice or shipping bill should be missed. So all these things are there, which are more of an advisory in nature, that how you have to do this. And this is the same thing which I just mentioned, that in case of export of service. Now, Vineet, just to share with you, I have attached all the forms as well, because it was my duty to share a complete 360-degree view, that these are the various forms which are related to this filing of refund claim. So in case you want to file a refund claim, the form is there. If the deficiency memo will be issued by the department that, okay, there is some mismatch, then they will issue in RFD 03. If they will issue a refund order, there will be RFD 04, or the rejection order will be there in the RFD 06. So these are the various forms which are being used by the department to intimate the SSC that what is the position of their refund claims.
These are really helpful, sir. Thank you.
Yeah. And now this is timelines. So because my friends will be looking that when they will get the refund. So this is the timeline presentation also I prepared, that when you are filing the refund claim, you have to file within 2 years. The officer who is reviewing your application, what he will do, that he will check whether your application is correct or not. And if the application is complete, they will issue within 15 days acknowledgement. But in case there is any deficiency is there, so what they will do, they will issue a deficiency in a form RFD 03, and then you will rectify that, and then you will file a revised application. Similarly, they will sanction, or they will partially sanction, or they will reject the claim, or they will create some kind of a adjustment with your any other liability. So all these procedures, that when they will do, what will be the rate of interest you will be getting, everything I have charted out in such a way that it will be very handy for our viewers, that they will be able to understand that how they have to follow, or the various aspects related to this refund business as far as the exports are concerned. Now, my dear friend, this is checklist I have shared with you that you have to attach with your refund application. So there are the CA certificate required in case of unjust enrichment, a cancelled check you have to attach with the RE006, GSTR 3B, GSTR 1, all these board resolution, power of attorney, everything you have to attach along with your refund applications. Now, my dear friend, coming to the next one, that is the arm length price. because now you are dealing with a related party. So we have in the GST, there is a separate provisions available like an OECD guidelines are there for the transfer pricing. Similarly, there are the guidelines, Vinayji, here in the GST law as far as the valuations are concerned. Now, in case you are dealing with a related party, so normally what will happen that if I am dealing with you, we are not related party, whatever will be the transaction value, that will be treated as an assessment value, assessable value. So TV means transaction value, AV means assessable value. So in case we are not related, so we are the unrelated party. In that case, the transaction will be treated as the transaction value will be the assessable value. But in case I am dealing between a related person, I am dealing with a related person, as you can see in the rule 28, that if I am dealing with a related person, in that case, what will happen? That my transaction value will not be treated as the assessable value. Now, what will happen? That there will be a separate rule which says that how to calculate the assessable value. As you can see in the transfer pricing, there are the methods available that they, for example, you have to calculate the, so there are 5-6 methods which are being given by the OECD guidelines and one has to follow. And there are the international jurisprudence around that. But in the GST law, one specific method which is being given, which I'm going to just share with you. But before that, I just wish to share with you who are the related parties as far as the GST law is concerned. So my dear friend, in case the person or the officers are the director in one other business. So if you have a holding company and a subsidiary company, or you are two different companies, but you are controlling that company through your directors, or you are the recognized partner in the business, employer-employee relationship is there, or you are holding more than 25% of the equity or the voting right or the stocks of the another company, directly or indirectly control the other or through a third person. In that all cases, they are treated as a related person. And in that case, the transaction value will not be the assessable value. And the assessable value will be calculated how? The assessable value will be calculated as I am going to show you. That this is all slides which are there. So assessable value will be calculated like this. Number one, the open market value. So in that case, the rule 28 of the CGST rules deal with this kind of a situation, which says the open market value. So you have to calculate the open market value. But in case the open market value is not available, then in that case, that you have to calculate. Say, for example, there is a barter transaction. So Vinitji, you provided me X services, I provided you the Y services. Now, both are, there is a barter transaction. There is no money flow. Now, how you will be able to calculate the assessable value on which the GST should be there? So they will do a equivalent to the money, meaning thereby, say, for example, I came to you to purchase a new printer. You told me that, okay, rather than charging the entire money, let us assume that there is a new printer for $1,000. Now I came to you with the old printer in exchange, and I gave you the old printer for, say, for example, and you charge me only the $700 for the new printer now. Now, what will be the assessable value? So if the transactions are with the related party, they are saying that we have to calculate the money equivalent to such consideration. So it will be $300 only, certainly. So the transaction value may be $700, but the assessable value on which the GST will be applicable will be the $1,000. Third one, that in case the value of the supply of goods or service or both like kind and quality, meaning thereby that in case for example, I am rendering you advisory services overseas, okay, and I am not charging. Let us assume that the person, my head office is located in USA, I am in India. I taken certain advisory from the USA office and not paid any amount. Now the department is saying, no, it's an import of service because you have taken the services from overseas company. But since I have not paid anything, they will say, no, you have to calculate the value on which you should pay the GST under the reverse charge mechanism because you are importing from outside India. In that case, how the value will be arrived will be the similar kind and quality. Meaning thereby, if the same opinion I have taken from a local consultant, okay, then what amount should I have paid? So in case I have paid the $500, so their department will say, now this is the similar kind and quality value. The $500 will be the assessable value on which you have to pay at the rate of 18%, the $90 to the government exchequer. But in case I am not able to calculate the open market value or the equivalent value or the similar kind and quality, then the rule 30 and 31 will come into the picture, which says cost plus 10% or with the reasonable means. So these are the valuation principles as which are more or less equivalent to the OECD guidelines, that how the transfer pricing calculation will be there. So what I am trying to convey you, what is the takeaway from entire discussion is that in the GST law also, there are the arm length price which is applicable. So if you are having a cross-border transaction with a related party, what is the related party? I explained you. In that case, there is a challenge that the valuation aspect will also be there, that in case you are dealing with a related party, you have to have the arm length price calculation as well to comply with the law. And last but not the least, that if you have claimed erroneous refund, you are treating yourself as a not intermediary. But later on, department is of the conclusion that you are an intermediary, meaning thereby your place of supply is in India only, and you should not have received the refund claim. So, my dear friend, in that case, as you can see, the tax erroneously refunded. You took the wrong refund, and the department is saying that you have committed a fraud as well. So, in that case, what will happen, Vineet, that in case the department is saying that there is a fraud as well, so not only the entire amount, whatever you have claimed the refund, you have to reverse, you have to pay back to the government, but also you have to pay the interest at the rate of 18% plus 100% penalty provision are also there. Meaning thereby, if you have claimed a refund of $18,000, not only you have to pay these 18,000 back along with the 18% interest, but also you have to pay the 18,000 as a penalty as well in case you have wrongly or erroneous refund is being taken from the department. Yes, this 100% penalty can be reduced to this 15%, 25% or a 50% in case you agree with the department immediately once the allegations are being raised by the department. But if you are contesting, no, I am not an intermediary. In that case, there are the possibility that you will win the case or there are the possibility you will lose the case. It will depend how the consultants are giving the advice to the companies that whether your activity is really an intermediary activity or not, really an export activity or not, is something that we need to deliberate. So, my dear friend, this was about this entire cross-border transaction. I just wish to share with you that in a very short time, I try to give you the gist. Number one, that how the activity will be classified or determined that they are export or not. Number one. Number two, that in case you are an exporter, that what all the possibilities are there. There are two schemes available. One is with LUT, another is without LUT. The third one, that you are getting the benefit of a refund claim of whatever the purchase tax you have paid, and there is no need to charge the tax from your buyer as well in case your activity is export. Number four, that in case what are the procedures you have to follow, what are the steps you have to follow to file the refund claim. And number five, that in case you are dealing with a related party, it is very important that we understand what is the arm length price. Number six, that if you are claiming an erroneous refund, then you have to reverse the refund along with the interest and penalty. And number seven, in case you are importing from outside India, you have to pay the basic custom duty plus IGST, which is available as a input tax credit or a set off later on when you are selling in the domestic market as far as the goods or the services are concerned. But for the services, there is no basic custom duty which is applicable. It is only for the goods when they are crossing the custom barrier. So this was all from my side as a presentation. As the Vineet told me that we have to sign off at complete my presentation at 8:20 or 8:21. So it is exactly 8:22 in Indian time. So now the next 10-15 minutes are there for any queries or the other procedures as far as your activities are concerned. Over to you, Vineet.
Thank you, sir. It has been really very enlightening, discussion. And obviously, all of us, at least in this forum, are connected in one way or the other with the GST, and especially it, snowballing into UAE and gradually other geographies also, where these forms of taxation was not involved. So there are a lot of questions and issues which come to our mind and which we come across during our routine professional life. So these pointers will be very helpful. Um, from our, I think, next step perspective, we will take a few questions here, and we appreciate that you had mentioned about about the time. It's like hard pressed for like 10-15 more minutes. You need to log off, so we'll try to close it before that, sir. If you allow, I just wanted to take up the question. So
Uh,
the first
yeah, I can
question
read. Yeah,
is,
Vineet, I can
yes,
read the
please.
question. So sales to
Okay,
entities
thank you so much.
located in SEZ are considered export. Avni, you are right that if I'm selling to a SEZ unit located in SEZ, then the same will be treated as export. And even if the repair services. So one thing is that if you are doing a repair services within the SEZ, then only they will be treated as export. But in case the uh, repair services, the machine is coming outside the SEZ and you are repairing in the domestic jurisdiction, then the benefit of the export will go away. So the same principle will be there as we can see in the export business, that the repair services located within the SEZ will certainly be export as well. Then coming to the next question of Avni, for import, if the custom duty plus IGST are paid, the custom duty portion can also be claimed as input credit. The answer is no. The custom duty benefit is not available in any jurisdiction. Likewise, in India, the custom duty will got subsumed into the cost of the product only. But the IGST paid can be claimed as an input credit while you are selling the same in the domestic market. So say for example, you are buying for 100 rupees, you are paying 18 rupees as a IGST, then you are selling for 120 rupees, you are claiming 21 rupees 60 paisa from the customer. Ultimately, you will end up paying 3 rupees 60 paisa to the government as your output liability, because the 18 rupees credit will be available to you against your purchases or imports from outside India. Sujit, yes, you can ask a query. Yeah, please write up your query. I am available. I believe, Avni, I have answered both the questions.
Yes, thank you. Just one small follow-up. So if
Yeah,
on an import, 18% IGST is applicable and say 10% import duty, your tax plus duty is really 28%, then it's not 10 plus 8, correct?
yes, you are right. So, for example, I am importing for $1,100 and custom duty will be $10,000, which will subsumed into the cost plus whatever the rate is applicable. So some items will attract 28%, some item will attract 18, 12, 5. So IG that will be the second portion will be called as IGST and will be available as a ITC.
Thank you.
Sorry, I thought Sujit was asking questions. Sujit, do you want to ask a question?
Yeah, can you hear me properly?
Yeah, thanks. Sujit, are you there? We are not able to hear you.
Yeah,
Sujit, your voice is not coming through.
can you hear me?
Yeah, perfect. Thank you. Please go ahead.
Actually, sir, in case the GST amount is not admissible, some amount is being deducted. So, but the entire amount gets deducted at time. So, is it possible to get the differential amount refunded as well, or no, credited into the ledger back?
Sujit, I am not able to get your question. Guesswork. You are saying that in your ITC ledger, rather than say, for example, you paid the purchase tax of 20,000 rupees, but actually that is getting reflected only 10,000 rupees. So can I get the refund of that 10,000? If the
So
question is this, the answer is yes.
yeah, another thing is that we have claimed for say $1,000, whatever, and but actually the amount was refunded was 8,000 only. So 2,000 was somehow because of something which was kind of deducted or not allowed.
So
So, but
deficiency. yeah. So you have to check whether this 2000 is a legitimate deduction or there was a confusion. So they will issue an order to you of 8,000 plus 2,000 rejection. And that is a appealable order. And you can file an appeal against that, maybe at the higher forum. And if your claim is legitimate, you will get the benefit or maybe at the higher forums.
Okay, sir. And one more query last, sir, in case we are importing goods, which is kind of, say, for example, some spare part, which is getting attached to a machinery and getting re-exported back to the customer. In that case, sir, actually, there is no accounting happening for that import thing, which is there, but we are paying custom duty and also, is it fine? Like, or, there is some deficiency in the process which we are doing
Sujit,
it.
I have to check the process, but on a layman answer, because it will be, as I mentioned, Vineet, that it will be a case-to-case, fact-to-fact basis. But
Okay.
just to share with you that in case you are importing, you are crossing the custom barrier, you are taking the spare parts into your domestic area, then you have to pay the custom duty along with the GST. And then whenever you are exporting later on, duly assembled in the machine as a complete machine, then you can claim the refund of the whatever the GST you have paid on the import. I'm saying again on a layman understanding, because I'm not aware about your facts. The another point is that you are not crossing the custom barrier. So in that case, there will not be any requirement to do all these things. So it's purely on a case, factual, facts of the case.
Thank you, sir. Understood.
Sir, I have a question, and it is very basic. I wanted to ask you, did share the situations where, professionals are providing services in India, sitting in India, providing services outside, based outside India, providing service to India and related aspects to it. So yes, in routine, we do get a lot of work which we are doing virtually, right? And sometimes the commercial arrangement is like that. Either the other party is not interested in talking about the GST impact on that professional transaction, or is not aware, and the professional being an individual or having a smaller setup is also not aware. So what are like a few basic checkpoints which a professional should do as soon as there is some transaction happening across border, especially online?
Vineet, I will request 3/4 aspect. Number one, that
Please,
you
sir.
should have the GST registration. Number
Okay.
two, you should apply for LUT. Number three, your activity should not be classified as a commission agent.
Okay.
Okay. And rest is fine. So if you will raise an invoice, you will find a refund claim. So that rest will be the procedure. The three very, very important aspect, that number one, take the registration, file a LUT, and your activity should not be classified as a commission agent.
Sure. And sir, is
Because at
the
times, Vineet,
registration
just
of
to share with
GST
you,
important, compulsory for all cross-border transactions, even by an individual who has not crossed the threshold?
yes, in case you are doing an export of services, there is a compulsory registration. Yes, if the turnover is less than 20 lakhs rupees, there is no like a registration is not required.
Okay. Thank you.
But just to share with you, normally what is happening in the agreements, even if the agreement is not related to the commission agent, they are mentioning the word rather than the fee, commission. So if you are processing the, say for example, you are doing a KPO, they will mention in the fee column that 10% commission will be there on this particular aspect. So this is a very
Right.
bad word in
Okay.
the eyes of the law. So even if your activity, so it's a substance over form. So what will happen that the substance nobody will see. They will more inclined to see the what word you have used. So they will say that in the agreement itself, it is mentioned you are a commission agent.